Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and let's try and talk about the pulls and pressures of the narrative that existed in the markets for the last couple of years, which justified the higher valuations versus the change in narrative, if any, with Ayaz Motiwala. He's a deep thinker, and I think it would help us to try and peel off some of the layers of his thoughts to try and understand what could happen going ahead. Ayaz, great having you. Thanks for joining in. Hope all is well.
Thank you, Neeraj. Good morning to you and your colleagues. Things are getting on. We have to, as you said, accept the reality and try and tweak and move forward.
Yeah,
that's what we do in the markets all the time.
Yeah, let's try and think through some of these thought processes that you may have, Ayaz. I want to start off with a point that I was thinking about for the last maybe 24 to 48 hours. There was this whole conversation which justified the way the markets are moving up, in that the economy and the markets need not necessarily be correlated, and as long as earnings growth stays strong, the equity market should do well. Now, the change out there seems to be that the heightened higher interest rates would probably bring down multiples, so that is one aspect. Lower liquidity in that. There's as much liquidity chasing stocks, so to say, and there's an alternative to stocks in terms of fixed income building up as well. The question to you is, do all of these lay out enough ammo for equity markets to stay in a protracted downturn for some time, or is this still a dip that will get bought into the way the last few have been?
Right. So you've raised sort of multiple issues in that one sort of long question, Neeraj. So I'll try and address some of the points. So firstly, I think the year and now, which is, let's define it as sort of March 20 to May 22. Essentially, the market in terms of indices went down in the early first quarter phase of the COVID-1 wave. Let's call it that way, essentially, and people took the year FY21 as an off year, essentially. So on that depressed base of 21, obviously the earnings growth for this year, ending March 22, have been very, very powerful. But that's the year and now near-term numbers. If you were to extend that on the Nifty delivered earnings or larger indices, BSE 500 or whatever. The earnings growth has been patchy and tepid, to say the least. Essentially, there is a lot of cuts that people do, X oil, X finance, etc. And we know what certain businesses or sectors have been going through. Let's say, right? So, naming one of them, financial services, especially the SOE banks, have gone through a massive round of restructuring of their loan book, write-downs and write-offs. Over the last 5-7 years, and have had very little to show in terms of core sort of ROE, reported ROE, and earnings growth on one side. We've also had a fairly benign sort of oil situation, and certain companies benefiting out of that, which may not have been the most sustainable sort of number, where oil was printing 30, 40 on the low and more like 60, which is a pretty benign scenario over the past sort of decade that one has observed. As a function of that, if I have to encapsulate that in sort of one sentence, it would be essentially we were going through fairly new levels or lower levels of inflation and interest rates as a function of that. That has led to a lot of other things coming about, along with imported capital in the form of the private market. We've talked about it in the past. We should bring that up on public and private valuations, because they are not functioning in vacuum, let's say, right? So that brings us to the question on, is it different, and where would things settle down? So I would say that the extension of the tepid, patchy earnings argument would be that when we are bottom-up investors and we continue to look for these islands of excellence or holes to hide in, and in the context of potentially our discussion of inflation and imported inflation on account of oil, soft commodities, etc., we think there are certain businesses which are unique and have either pricing power or are uniquely placed. And those are some of the places where investors should put their money in over the next 24, 36 months. Now, the fact of the matter is that these businesses have always been richly valued. And in the last couple of years, such as, say, IT services, or maybe a little more, maybe 3 to 4 years, their valuation multiples have actually doubled. So we had at the low of 17, 18, Infosys, TCS trading in the ballpark of 18, 20 times, sort of trailing earnings. And they're probably trading at mid 30s, to say the least. This is after a 15, 20% correction. Similarly, consumer companies have probably put on 50% re-rating in their valuations. Most stocks on a 3 to 5 year basis have doubled. Earnings of these stocks have been at best in the ballpark of 8 to 10% annualized. So these are some of the sectors where actually there is uniqueness or perceived to be pricing power. There have been other exciting sort of growth stories in India. One which really stands out has been, let's say, the chemical sector. There I would want to take the forward view by saying that a lot of that is a reality and is going to build on, which is this China plus one argument. I would put it in my way to say basically new supply chains being created essentially, right? So if you take the new world order, there's a lot of inwardness which is coming in. People talk about globalization, and I think we have our own sort of Indian unique approach of Atmanirbhar Bharat. So, Bharat has been Atmanirbhar in most things except crude oil. And so we have this crude oil imported challenge and high inflation. And we accept that not now, but on a 20, 30 year basis. That's the reality of our country's balance sheet. Sure. But that being said, if these new supply chain lines are going to be relayed, and essentially this is on consumers in Europe, America, or rest of the world, wanting to source material on a sustainable basis from businesses. It extends beyond chemicals, but the chemicals sort of stand out. And that's why this whole PLI scheme across textiles, across chemicals, across consumer durable assembly companies, including the likes of Apple. I think that's another opportunity, which is more durable and enduring. And this will sort of sustain. So these are some of the thoughts to the very long question. I've taken a while to explain my points as well. Thank you.
No, not at all. So let me ask you, Ayaz, are you wanting to add money or significant dollops of money to some of these promising stories currently? Or do you believe that because of the macro factors, there could be, even from a tactical perspective, more downside to some of these promising stories as well?
I mean, the straight answer, Neeraj, on essentially re-rating is, and I have this sort of one line, which is, you buy stocks, the market gives you the multiples. So the market give it and the market take it, essentially. So it is very tough to say the chemical companies or the consumer companies which were bumped up in 2x in their multiples, including say IT, pharma, etc. Whether there will be this multiple correction, a sharp here and now, or will this be a protracted drag, as you point out, where there is some element of earnings coming in and this goes down over 18 months. My sense is that certain businesses will have that sort of gradual descent because of the nature of their business and how the past has been. And so I think consumer companies or IT companies will stand out there because they are printing 10 to 20% EPS growth even as we speak. Whereas we've seen in the most recently reported quarter, there's been quite a wobble in the chemical type companies. And the whole complex is not reporting straight line numbers. Yeah. So it's now very bottom up, individual factors of each of these companies and how they're doing, whether it's their back end raw material or their pricing power and everything else in between, shipping, transportation costs, etc. So I guess there the market has corrected some of these very sharply, and there could be some room in those. Similarly, in sort of commodities, in terms of other things, there's a whole host of businesses which we can talk about. But I want to say, broad brush, there is a potential. I would want to think 10 to 15% downside, which would make it extremely attractive as a high level sort of point. And to put that in numbers, I mean, we are talking about Sensex in the ballpark of 52,000 had such a scenario were to come about. It would make it extremely attractive. And so in the interim, the cash positions we're sitting on right now or have created, it is the relative bets of sort of shuffling names and moving names around in the portfolio.
Got it. Okay, let me try and take each of those factors, Ayaz, each of the points that you mentioned. So let's say technology services. And I'm not using consumer tech here, just IT services as a pack. Somebody was making this point that if you look at the last 3 years or the last 10 years as well, Infosys, as you rightly said, has been a valuation growth story, not as much as an earnings growth story. Yes, it's been there, but nowhere close to the bump up that's happening in valuations. Whereas if you look at the broader end of the spectrum, a bunch of fairly competent mid-sized IT names are growing well, and the commentary seems to be that they'll continue to grow well. So are you now picking and choosing between the Infosys and the TCSs of the world, which are arguably the two most highly valued large cap names? The others are kind of sub 20, versus the mid-sized ones, because there the growth might be a bit more present for the foreseeable future. Sure. A bit more growth than the others.
Yeah, that's a great sort of question that you raised, Neeraj. And so some of the thoughts are as follows. Essentially, as observed, and since you quote decadal sort of period, and we go back because it's also some bit of the perception that this is the second version of Y2K, etc., or the dot bomb, as people call it. So post Y2K, what was observed was that the large grew larger, but also grew faster. And there was almost a disappearance of the mid-cap IT services company in India, till the emergence of Mindtree, till the catch-up of HCL Tech, till the growth focus of NIIT Tech or Coforge, and a few other such names that we were sort of clinging on to. Clearly, in the last 3, 4, 5 years, a few other companies have emerged, such as, for quoting names, L&T Infotech, more recently Happiest Minds, etc. So I would think that we own a combination of such names. We think that the assurance that a TCS stroke Infosys brings on the table in terms of a 8 to 10% on a sustainable basis in the digital brought forward COVID-driven environment, maybe 12 to 15 as they've quoted, and they've given some sort of guidance, is a good assuring earnings growth visibility. Because if you look around the whole marketplace, there are few and far in between such assurance of earnings growth stories, apart from the quality of the business in terms of profitability and its unique strength in terms of IT services. The other side, which we also lean on, we know of names such as, say, Tata Elxsi or LTTS. These are very interesting businesses. They are, services-driven model, but there is this, the earlier point I made about the Indian strength on, design, technology, outsourcing, combined with this whole PLI and a few other points which come together, that there is this enough of labor pool or talent pool which can help, help these companies offer these solutions to global industrial stroke auto majors, as technology is evolving, and we know in automotive, there's a lot of software already present. And, as the Economist or other such publications quote, that this number is only rising as we speak, right? So, so if you combine the fact that the world will move to EV, 2030, 40, 50, God knows when, combined with the fact that there is this element of software increase and the reduction of moving parts and hardware, there is this large opportunity which is there, right? So these are, for want of this sort of word, these are underlying structural opportunities. They would get painted in the same brush of this sell-off which has happened. So all of these names, the second-tier names, have had a bit of a dip in share prices. L&T, Mindtree, which are unique sort of digital leading companies, have decided to come together. Market probably wants a more sharper focused play, and so they've had a little bit of a higher decline there. But they have been leading the digital transformation charge versus the other majors who played a catch up, and now every conversation of TCS or Infosys is also quoting that digitalization, digital transformation business as a number. So I think the answer is that we will have a combination of a couple of large leading companies along with opportunistic bets on companies which have not a fleeting opportunity, just a services demand, digital has transformed, but more with an underlying promise, such as the one which I described.
Not a fleeting opportunity, such a key thing to try and figure out. So I hope that viewers take note of that. Chemicals has been interesting, right? A discovery of sorts in the last 5 years, and all went up before the market started to punish those which probably didn't have pricing power or backward integration or combination of all of these. Now, my question is, if we look at the last 2 or 3 quarters, and correct me if I'm wrong, Ayaz, but it seems that fluorination as a pocket or 1 or 2 pockets probably seem to weather this storm a lot better than some of the others, which had a lot of promise, be it phenol companies, be it some of the others. How are you approaching this now? Because as you said, even this is not a fleeting opportunity. It seems to be a really long-term opportunity.
Yeah, that's again a great question, Neeraj. Like it happens, and I want to say that the chemicals business as of the listed companies in India is probably the most bottom-up differentiated sort of sector, and so it'll be unfair to club all businesses in terms of the way we look at them as financial investors. Our desire would be to own companies which make money in a very simple construct, and that too on a sustainable basis and a lot of money. But that being said, as it happens that you can call it second or the third leg of the bullishness, which probably came in parts. So we had a phase of 12 to 15, then we had a 15, 18 sort of discovery and beyond, and then the last 3-4 years has been this massive bull charge. And if you were to put that in perspective, what happens is that everything gets painted in the same brush. And so all companies sort of started getting quoted at very, very, expensive valuations, to say the least. Now, some of the larger companies that you named, such as, say, call it Navin Fluorine, Atul, Vinati Organics, etc., or Deepak Nitrate, etc., these have been around, for more than a decade before this boom, and they were very focused in the business model. Most of them were or are specialty chem companies, very specialty focused, and have either pockets of commodity element to their business or have none at one level. Second, they have had a fairly integrated business model, barring sort of, the crude oil derivatives. Their key starting materials they are linked fairly high upstream, all the way to the finished product that they sell to the consumers. In addition, their market positioning is very strong. They are amongst the leading players or the leading suppliers in the global sense of things. And I'm talking about some of these names clearly, right? So that's why the business have been reporting decent numbers that you quote, and I agree, over the last 2 to 4 quarters. And And the market's appreciating that because the business is more steadier in such trying circumstances, such as a sharp increase in freight costs, and maybe that's not a pass through, a sharp increase in commodity and partly not pass through, etc., and still delivering very solid numbers, right? So I guess the strength of this is the underlying business, and that's what the focus is for us. That these businesses are far more robust and solid, and they are coming to demonstrate their true colors, as we say as investors, in tough markets. So for us as money managers, I think the evaluation should be how did we do in a very tough market or a bear market. And similarly, companies, whether it's cement, steel, specialty chemicals, or IT services consumer, should be on when there is winds of change, how and what was the true strength demonstrated by those companies. So I'm actually quite impressed by the fluorination stroke single or two category type companies, where they have a single large product which is growing. They're global number one, number two kind of player, and being able to protect the business model thus far. Obviously, markets sort of going forward, so we'll have to see, whether there were some upfront raw materials which were bought, which could have been contributing to this sustainability. So the watch out would also be this particular year, 23. Again, coming to that earnings story that you had brought up for all companies. So, I was just reading a newspaper article on Business Line which quoted EPS growth and profit metrics of Indian companies, and they've had they quoted very decent sort of 4-quarter numbers, right? And the reason for that is that the margins through this period have been managed with with the combination of volume and price increases, etc. The question of markets as a forward-looking sort of mechanism is what's the outlook for 23, which is kind of what we are at in this conversation as well. And I think one has to be a little more watchful here. Not necessarily only on our discussion of chemicals or IT services companies, and try and see where this takes us in terms of the sustainability. And I think it will separate out. So it's the market's beautifully laid out. In tough situations, we will start seeing businesses fall by the wayside. We can see that even in such branded, robust businesses as consumer businesses, where certain businesses, let's talk about immediate here and now, last 2 days results. We can see the results of Asian Paints and say Kansai, and not only the last 9 months or 3 quarters, but over even a 3-year period or a 4-year period. So I think it's very clear. You take that out in consumer companies, you can see a certain type of hair oil store consumer company in diversified versus an undiversified company whose numbers have fallen 20 to 40%, whereas these companies have delivered 5 to 10% EPS growth positive. So the market is appreciative of that, and you can see that X stock is down 20% from its lifetime highs, whereas Y stock is probably down, down lower than the COVID lows in some cases, right?
Yeah,
so I think that should be telling. That should be telling.
In fact, you kind of preempted my question. I was going to ask you, squeeze in a couple of consumer questions as well, Ayaz. And coincidentally, I was going to bring up that point of what Asian Paints had to say and has delivered, or for that matter, what Titan told me, where in their view is that Tanishq can continue to grow very, very strongly, according to him, for the next 15, 20 years, because they are still in single-digit market share and so much to capture. Now, my question is, these are some of these large businesses which have a very strong moat, are trading at stiff valuations even now. Would you, in such times, would you look at the very near term and try and determine whether you want to buy? Or do you look at a very long opportunity, believe that the company will execute because it has done well in the past, and go out and buy? What do you do? Specifically because these times are not how maybe 2019 or 2021 was.
Yeah, it's a sort of $1 billion question. It's a very tough question, Neeraj, honestly. As I said back then, that you buy stocks, market gives you the multiples. Um, and I strongly believe in that, let's say. So build on that. I think we can borrow from history on what can be expected returns then. So then we should be very clear about, and that is all interlinked essentially. And so this is our core belief. Uh, we go back to history on, say, IT services in the late 90s. Infosys, Wipro, and TCS was not listed, but later. Infosys, Wipro, as that time's sort of poster boys, they stand out. They took many years, and I want to call it even decade, to take out those high prices. And with that starting point multiple, the 2000 to 2010 returns of Infosys were very ordinary. And then that's a quoted fact. So these are financial facts for us to appreciate. With the fact that Infosys had underlying tailwind of growth, and they probably had high teens to even 20s kind of EPS growth for that long 5, 7, 10-year period, right? So one is the business printing and EPS growth on one side, and then there's the market multiple expansion or contraction argument, right? So I hear you on Asian Paints, large opportunity, home decor, beyond, they're trying to do that. Titan, a simple, massive opportunity. They're under double-digit market share. It's a very unorganized market, and the trust factor of Tata, which they're highlighting across the entire spectrum of their companies, including digital that they're launching or otherwise, they have a very large opportunity. But I would put that the opportunity to translate into share price performance or suboptimal, if you have bargained for a 20% return or an EPS growth equal to share price growth kind of argument, I guess I would own it up, we should be prepared for some bit of dissonance and disappointment. Because again, factors and markets change, right? So the last point would be that a very long extended outlook on earnings growth of such companies also means to the principle of, let's say, how long bonds are valued and stocks are, for some people, basically perpetual kind of debt, let's say, okay? So the principle on that is two things only: duration and interest rate changes, essentially. So, and a very minor change for highly discounted stocks would mean a massive change in value, very simply. So the point which you had raised about tech companies or consumer tech, which is going on in the background, we've not come to that. But this would apply to the 70, 90p stocks as well, that they have, essentially 70 would mean its discount rate is 1.5%, right? So a minor change of 50 basis points, what's called price value basis point change in a long duration bonds, they will have an impact. They will clearly have an impact on multiples or the returns that one makes. So lastly, I think what we are trying to do is sort of wean through that street, because we want to be in that street. It's an attractive street, but we want to be in some corner where we try and blend the combination of growth outlook, ROE, productivity, solid market share, moat, etc., and try and say where it would trade in a 3-5 year scenario, in bullish or duress kind of situation, and that's what could be the investment outcome. And that, I think, gets us to that first question that you started the discussion with. The long-term returns of India over a 10 and 20-year period has been 12 to 14% ballpark. That's not being violated even in this bull market. So pointedly, people are stuck on some 26,000 Sensex and said, oh, market double ho gaya kind of situation. If you take 2018 as the 40,000 top, and you say 60,000 now also, which is not, you're probably in the same 50% returns over 4 years and ballpark 12% simple. Yeah. So we are not actually off. We are not overly attractive. We are sort of going in the long-term trajectory of Indian nominal GDP growth in the ballpark of, more like 10 to 12 in the recent 3-4 years, but the long term being 13-14%. So I think those are important factors, for buying these expensive consumer companies, or this is your return expectation, what's been the long thing, and you should be aware that there could be a suboptimal outcome.
Yeah. Well, Ayaz, trust me, this is so amazing. I could go on for another 37 minutes, but you've taken a lot of your time already. But I would love it, Ayaz. This is about the 12th of May. If we can do a conversation slightly sooner, wherein we can talk in detail about how you're approaching consumer tech as a separate conversation by itself.
Sure.
It'd be lovely to do that sometime in June or July, should you find the time.
Sure. Yeah. So I look forward to that, and I would make the comments at that point in time. Suffice to say that I think having learned it from one of the veteran investors in India, is I don't think the financing environment is a determination of the strength and the character of the business. So if a certain business is just not making money and you're throwing money at it, I don't think the character of the business would change in the foreseeable future. So I would leave it at that, and build on this, on what I mean by character of the business and what it can make. But suffice to say that traditional consumer companies are making these kind of ROEs. They've never had a cash call. They always have funded businesses for growth. And the investor should be more than happy that they've got this growth funded with their own profits on a decadal basis. So that is the free cash flow generation capability of these businesses, what they put it to work, and they have growth in EPS over decades. So the other ones have a long catch up to do.
Well, viewers take the hint of what he's saying, but I think we should talk about this in greater detail at another opportune time. But Ayaz, this was fantastic. Thank you so much for speaking to us today.
Thank you, Neeraj. Appreciate it.
The pleasure was ours, and viewers, thanks for tuning in.